You've probably noticed something big is shifting beneath the surface of the markets. For the last few years, a handful of trades have completely dominated investor behavior. They were the consensus trades, the positions everyone agreed were safe, inevitable, or can't miss. But over the last 3 weeks, we've started to see those consensus trades crack. Look at Bitcoin, and by extension, MicroStrategy. These were treated as the ultimate liquidity trades. But as global liquidity tightens and volatility creeps back in, the once unquestioned narrative of digital gold is being tested. Then there's the AI complex, NVIDIA, the hyperscalers, and the entire momentum factor. For a long time, they've powered indexes higher and dominated flows. But the data now show clear signs of fatigue, declining relative strength, crowding at extremes, and even short-term breakdowns in momentum ETFs. This is what happens when everyone's positioned on the same side of the trade. Eventually, there's no one left to buy. Even the NASDAQ itself, driven by a handful of mega caps, is showing early signs of concentration risk. When just a few names drive the bulk of returns, any shift in sentiment or earnings expectations can ripple through the entire market. So what's really going on? Markets are beginning to price liquidity scarcity, positioning saturation, and narrative exhaustion. In plain English, investors are realizing that no trade wins forever. That's why risk management, diversification, and factor balance matter now more than ever. Because when consensus trades start to break, volatility doesn't just spike, it rotates. Money moves out of what's crowded and into what's ignored. If your portfolio is heavily tilted toward yesterday's winners, now's the time to reassess. The best opportunities often emerge right when consensus starts to crack. I'm Billy Desai, founder of Analog Capital Partners, and this is exactly the kind of regime change we help clients navigate.